Hello, fellow traders. 'Tis I, TheRumpledOne. It is Wednesday, July 31st, last day of the month, year 2019. Let's talk trading. So we'll do the monthly wrap up, and we've got FOMC coming up. I don't know if you'll see this video before the FOMC announcement or not, but I will have it up shortly. So for the month, I hope you employed your risk and money management and you did not lose any more on any single trade than you were willing to lose. That is just so important. And also just remember these videos are for educational purposes only, and that your results may be different from mine. And if you need financial advice, seek it from an accredited financial professional. Okay, let's see. We've got some gaps filled here. We pretty much know these pound pairs probably will not fill this week unless there's just some really crazy news comes out. But we also have the dollar franc that hasn't filled. Taking a look at the euro yen here on the weekly, we're only 10 pips off that low. You see right here, we are back inside the candle body. So we exited the upper wick zone. And you can see the weekly range really isn't much so far. Okay, the pivot point was inside the buy zones. So right next door to the weekly or to the daily open. So there was no bias really given with this pivot point. Of course, it only being a couple 1.1 pips away, it filled. But actually, it could have possibly, price could have opened, never moved up, and just dropped. But so it did fill. As you can see, we had a short trigger early, and then we showed it pulled back. If you were still in the trade, you see it didn't make a lower low. That should have been a scratch trade. Here, once again, you see is making lower lows, but it kept closing green. So right about here should have been just a small profit. Then finally, you entered a trade and it paid off. Cross below the weekly open on the cross above. That should have been a sign to take profit and possibly wait for another cross to the downside. Daily range, we've got 1, 2, 3, 4, 5, 6 pairs over 100. They're all the pound pairs. Notice close to open, they're all positive after the big drop. What was it, yesterday or the day before? We were looking at 200 pip drop. So there was some recovery. And you can see close to low, just way out of the rat zone. As far as the euro yen, you see here we broke the previous day's low. And if you nailed it, that was good for about 10 or 11 pips. On the Einstein line, we just got a long trigger here. So far, good for about 3 pips. And once again, the weekly range here on the euro yen's only 65, way below average. Price action using the 3-level ZZ, 1 ball, pro trade red at the line, 3 ball, pro trade right here, crossing above, or just pure price action, knowing that it's very unusual for a 1-hour bar to open in between 2 lines and not exit. Simply because the average range is 11. Here I changed up the chart. Normally I have the daily wick zone line showing here. But instead, actually, let's make one little change here. I just noticed something to show you guys how to do this. We'll do one bar and shift of 1. We'll show the previous week's wick zone lines. And you can see here, previous week, but what's happened during the current week. Right here, put up the weekly chart. And then we can drop down to the daily. And drop down to H4. So you can see the movement even further down and even all the way down to H1. And you can see the movement. Once again, simple horizontal lines telling the tale. You see here, tried to break out of the previous week's high, failed, came back, stayed in that upper wick zone, and finally came out. Dipped into the lower wick zone and came out. Because the wick zones were huge last week. And let me switch over to dollar yen because I noticed something that I wanted to show traders, especially those who seem to need an oscillator or a moving average to say whether or not price is going up or down and to decide which way to trade. If you look here at H1 and you put your cursor right here, you see all those wicks below that line earlier in the day here, from here to here. Then you saw what happened 2 hours ago. Put right here where all those wicks are, and you see how price dipped back into the wick zone and then shot up. That's all you really need to look at. And then if you even pull it down lower, you see these two right here. You see how price once again dipped into that wick zone area and then moved up. I mean, it tells a tale. It really does. You don't need to think of support and resistance. You don't need to think in terms of supply and demand. You don't need to use any trend oscillators or anything like that. You don't even need an indicator on your chart. We can even turn it off. See? Turn the indicator off. And just by clicking on the button on your cursor on your mouse and just looking, or if you didn't even use that, when price was down here, you saw how many wicks it was cutting. So it'd be very easy to go long, put your stop loss right there, calculate your position size, and basically say, okay, based on the history, price gets down here, it goes up, and it might only go up about 10 or so pips, but that's a 10 or so pip trade that will be profitable. You see, I do look at other traders' videos, and I look at the emails they send me on a regular recurrent basis, which is practically daily, and they keep trying to tell me of all these fancy, divergence indicators. I mean, I studied divergence over a decade ago. It took me a while to understand it, but when I got it, and I wrote all kind of stock fetcher filters on divergence, and I've got some MT4 indicators that show divergence with almost all the lower indicators and divergence between like the pound and the euro. But I mean, if you want to use it, that's okay. If that works for you, that's fine. But to me, just simply looking at what price does at these levels, I mean, it's kind of obvious. Price comes down here and it shoots up. Now, Can it break out? Yes. And it could break down, break out to the downside for 100 or more pips. But the thing is, it's real simple. I've got my stop loss in place. So if it does start to break, it will stop me out and I will not lose more than I'm willing to lose on that particular trade. But, based on history, these trades were all going to be profitable. It just comes down to that line. So you don't need all those fancy indicators and seminars and all that stuff. You can just learn to just look at the chart and see with your own two eyes what price is doing. And, I like to look at the hourly, but, you can do the same thing on H4. I mean, once again, there it is. You see right here, price dips in that wick zone. So right there on H4, you have the same thing. Or if you want to do even a longer term, you can look at the daily. We can even scrunch the chart in a little bit more. And now it looks like, and you can't really see the wicks when I scrunch it in that far. Here we go. But I mean, right there, you see the wick zone action here. You look back, you see wick zone action there. It's not that difficult. And anybody wants to say it's hindsight, you go right ahead. But you can do it in the future, and you can do it for the shorts too. I mean, look right here. You can put that trade on daily. It's like, hey, if price falls below that line, I'm going to go short. And where would you put your stop? Oh, maybe a pip or two above that level. It's not difficult. It really isn't. But there are traders out there who want to separate you from what's in your wallet or pocketbook or money clip, your account. They want to take your money and sell you their idea on how to trade. And see, that's why the only thing I sell or have for sale are drain the bank t-shirts, because I just thought they were cool. And I still have a few for sale, but that's not why I'm making this video. I'm just making it to show you guys how simple it is. So back to the euro yen, and we said we're going to look at the monthly, and you can see here where we are in the month. So we're going to have a down month, and I think this month's looks like it's going to be an outside bar. So we'll see what happens. Outside bars, you want to take, once again, just trade. If it hits the top, you go long. If it hits that bottom, the low, you go short. Top, or actually I should have said if it hits that high, you go long. Hits the low. And then you can also trade using the wick zones if you want to trade back into the body of the candle. It's just not difficult. I mean, these wicks tell the tale. You can see right here on the monthly. The wicks tell the tale, especially if you want to trade long term. You can do the same on the weekly. But in order to do that and to have the confidence, you have to apply your stop loss. So, fellow traders, I really hope you had a profitable month trading. Thanks for watching my videos. Next month, I think we were going to pick a pair that I've never traded. What was it? The pound Aussie or something, pound Canadian. We were going to pick one of those pairs, and we were going to trade it for the month using these methods and to see just how profitable we can be. So, FOMC coming up today. Have your stops ready, because remember, it's not what you trade, it's how you trade it. So go out there and drain the banks.